The emerging market countries had so much momentum 6 months ago, they probably won't have recessions, but their growth rates will slow. In Southeast Asia, the growth rate will probably go from 7 down to 3.5%. Africa will grow from 6.5, maybe down to 4.5. Latin America, 5.5, down to 3.5. The most important country on this list is China, because China now has a $3.5 trillion GDP. It is now the 4th largest economy in the world. Only the US and Japan are larger. And China will catch up with Japan sometime probably in the next 5 years. Now, China's growth rate was 12% last year. The best guess for this year is 9.5%. I was in Beijing a fortnight ago talking to a lot of economists who thought that if we didn't get a policy response, growth next year might slow as little as 6%. But Sunday, last week, China announced a $600 billion infrastructure stimulus package to try and maintain the growth rate at 8% plus. This was a very, very dramatic announcement. It's been by far the most dramatic economic policy announcement of any country in the world in the last 3 months. And the Chinese can do this because they're sitting on $1.9 trillion of foreign exchange reserves. Because of the boom they've had in the economy, they're running a budget surplus. There are no constraints on China's ability to stimulate its economy. China can stimulate even more if it wanted to because it has tremendous financial resources. And the fact is, all the East Asian countries are not that different. The East Asian countries collectively are sitting on $4.3 trillion of foreign exchange reserves. Korea, $250 billion. Taiwan, $320 billion. Malaysia, $110 billion. Singapore and Hong Kong, $160 billion each. Even Indonesia has $60 billion in reserves. All these countries could stimulate domestic demand if they want to. And in the last fortnight, Malaysia and Korea have announced economic stimulus programs. This is, I think, very, very healthy, because we've had a world economy that depended for too long on the US consumer to give us a growth locomotive. The US consumer is now gone. The US consumer is gone for at least a year, maybe 2 or 3 years. We have to find an alternative, and these policy changes going on right now in East Asia will help to compensate. They can't fully compensate because the US consumer is worth $10 trillion a year. The US consumer is 71% of our GDP. Chinese consumer spending is barely $1 trillion. The rest of East Asia, a few hundred billion. So it can't fully compensate, but still I think these policy actions are important because they show that these countries are trying to take responsibility for their own economy, not just relying on America and export-led growth to sustain their overall rate of economic growth. This is, I think, a very healthy rebalancing. But the problem is it will not prevent in the year ahead a major slowdown in the US, European, and Japanese economies, and a broad slowdown in the global economy as a whole. So that's where we are. We've got a recession in the G7 countries and a major slowdown going on in the emerging market countries. But what does this mean for you as investors, people coming to this conference? Well, the first effect, of course, has been seen in the last few months in the commodity markets. We had a big decline in lead and zinc prices going back a year ago. Then nickel turned down. Copper held up until July. But now copper's fallen in half in the last 3 months. And the price is still yet to fall are iron ore and coal. Iron ore has been held up for the last 4 years by robust Chinese demand. But in China now, the steel companies are losing money, and spot iron ore prices in China have fallen 50% here in the last 3 or 4 months. So I think when BHP and RTZ renegotiate their big iron ore contracts in February of next year, they'll be forced to take a 20 or 30% price cut. So we will have all the metals finally falling quite significantly by early next year, not just the traditional base metals like lead, zinc, and copper. The oil price, of course, has also had a big decline from a peak of 147 in July to 55, 56 here in the last 2 or 3 days. This is not an unusual cyclical response. In every recession we've had in the modern period, metal prices always fell. What was unique about this business cycle, though, was the role played by China. In 2003 and 2004, we passed a great landmark in world economic history in which China displaced America to become the dominant consumer of all base metals. If you look at the breakdown of global copper consumption, China is now 28%, the US is only 16%. If you look at steel, China now produces 500 million tons of steel a year. The US and Japan each produce 100 million tons. Korea is about 60 million tons. China now dominates the base metals market. And what has caused this big decline since July is concern about the Chinese economy. And that's why when they announced the big infrastructure program on Monday, or on Sunday rather, it did trigger a brief rally on Monday and Tuesday in some metal prices. So here are the critical issues I think we have to focus on in the year ahead. First, as I mentioned a minute ago, we have this extraordinary expansion going on in the Federal Reserve's balance sheet. If any gold bug looked at these numbers, the gold bug would say to you, this guarantees high inflation in 2 or 3 years. The reality is, Ben Bernanke right now is fighting deflation. He thinks this recession could be so severe, it might lead to deflation. He's no longer concerned about inflation at all. But if the Fed does keep injecting liquidity on a massive scale, if its balance sheet grows to $3 and $4 trillion, I can assure you the gold bug community will be concerned. And they will see the danger of inflation lurking somewhere down the road, if not in 2009, certainly in 2010 or 11. Secondly, Barack Obama is going to have a profound impact on monetary policy upon taking over the White House in 2 months. Right now, for the first time in American history, we have 3 vacancies on the Federal Reserve Board. We've had 2 vacancies. We've had a vacancy for over a year. Another governor stepped down in September. Another governor's term ended back in January, but he's still serving. Under the rules, you can serve until somebody else actually replaces you. But he couldn't get a confirmation from Senator Dodd of Connecticut, who runs the Financial Services Committee, or runs the Confirmation Committee, and the result is he'll probably have to go in January and return to the University of Chicago. So Barack Obama will name 3 new governors. 3 new governors will have a very big impact on monetary policy that we simply can't forecast right now. In a year's time, the term of Ben Bernanke will end as Federal Reserve Chairman. We just don't know whether he'll get reappointed or not. I think Bernanke's done a good enough job here this year. He has a lot of support on Wall Street. But there are no guarantees that support on Wall Street will get you the job. There may be other people in the Obama team who would like the job, one of whom is Larry Summers. Larry Summers right now is competing for the job of Treasury Secretary. He has some chance of getting it, but he's not guaranteed. There's another prominent candidate with Tim Geithner. If Larry doesn't get the job of Treasury Secretary next month, he might make a play for Bernanke's job in a year's time. The Democrats also like Janet Yellen, the president of the San Francisco Fed. She was chairman of the Council of Economic Advisors 10 years ago. She'd be the first woman to ever serve as chairman of the Federal Reserve. Obama might find that very interesting and very attractive. So that job is also uncertain. And what that means is we have a hard time right now predicting where U.S. monetary policy will be in 12 or 15 months. I have no doubt that Ben Bernanke believed at this time last year he'd be raising interest rates in 2009 and 10 to contain inflation. Now, because of the scope of this crisis, he may never raise interest rates again in his current term. But I'm sure he thinks in the back of his mind with this massive liquidity creation, at some point out there, maybe 2010 or 2011, he'll have to tighten up and contain the inflation danger. If he goes, when we get somebody like Larry Summers, there's no guarantee what he will do. Larry Summers I've known for many years, and in his private thoughts, he has a real bias in favor of growth. I think Larry Summers would take inflation risks. And if he did, believe me, that would have an electrifying effect at some point on the currency markets and on the gold market. You could see the dollar once again be a weak currency. We could see the price of gold double. We could have tremendous moves in mining values in 2 years if we get a new central bank which is perceived as too easy and too soft in the aftermath of this crisis. Third big issue will be China. Can China, through this massive infrastructure program, sustain 8% growth or even higher? If China can achieve that goal, that will create a bottom under metal prices higher than would have been the case in the past. In 2001, the price of copper got down to 75 cents. We've now gone from $4 down to $1.50. If China couldn't sustain high growth, we might get back to 75 cents. But if China can sustain a high growth rate with tremendous demand for metals to finance all these big new, or to accommodate these big new construction projects, copper might bottom out at $1.50, which would be, for a lot of companies, a level of prices at which they could still make money. So China's performance will also be critically important to what happens in the commodity markets in the year ahead.